If you're in your 20s, I think investing has become way too complicated. Everyone is trying to find the next Nvidia, the next Bitcoin, the next stock that's going to explode 1000% in 6 months. Meanwhile, I've spent years building a portfolio that's designed to do the opposite, to get rich slowly, on purpose, with as little stress as possible. Today, I'll show you exactly how I have $412,000 invested at 26 years old, every ETF I own, the exact percentages, why I own each one, and how you can copy the same framework starting with just $100. Before I show you the portfolio, let me give you some context because I think it matters. Nobody in my family talked about money growing up. Investing wasn't something we discussed. I had to figure it out on my own. And when I first started putting money into the market, my strategy was basically just guessing. I was picking individual stocks, trying to catch things at the right moment, staying up late watching charts. And I want to be honest with you, it was stressful. It wasn't working. And I was making the whole thing way more complicated than it needed to be. The story that actually changed everything for me was Warren Buffett's famous bet. Back in 2008, he made a 10-year wager against a group of professional hedge funds, people who invest full-time with access to tools and information most of us will never have. His bet was that he could get a better return by simply putting money into a low-cost index fund, not timing anything, not picking individual companies, just letting it sit. 10 years later, he won, and it wasn't even close. The hedge funds, with all their complexity and effort, couldn't beat a fund that basically just sits there. That story completely rewired how I think about investing. And it's the reason why the core of my portfolio is built around ETFs instead of individual stock picks. Quick disclaimer before we get into it. This is my personal portfolio. This is not financial advice. Past performance doesn't guarantee future results. Please do your own research. All right, let's get into it. The first and biggest position is VOO. That's Vanguard's S&P 500 ETF, and it makes up 45% of my portfolio, the single largest chunk by far. VOO tracks the 500 largest companies in the United States. Apple, Microsoft, Nvidia, Amazon, all of them in one single fund. As of June 2026, VOO crossed $1 trillion in assets, making it one of the largest ETFs ever built. And there's a reason for that. Millions of investors around the world have come to the same conclusion I did. The expense ratio is 0.03%, which means for every $10,000 you invest, you pay $3 per year in fees. VOO has delivered strong double-digit annualized returns over the past decade, though that number shifts with market conditions. What matters is the long-term direction. And over any significant time horizon, this fund has consistently rewarded patient investors. The way it works is that the fund tracks the S&P 500 index, so as companies grow and earn their spot in the top 500, they get included. When companies fall off, they exit. You're not betting on any single business. You're betting on the continued growth of the American economy over decades, and that's a bet I'm very comfortable making. The second position is QQQM. That's the Invesco NASDAQ 100 ETF, and it's 20% of my portfolio. Where VOO gives me the 500 largest U.S. companies across all sectors, QQQM focuses specifically on the NASDAQ 100, which means much heavier concentration in technology and growth companies like Nvidia, Meta, Broadcom, and Tesla. I'll be honest, there's significant overlap between VOO and QQQM, and you don't technically need both. But I added QQQM because I genuinely believe technology is going to drive the global economy for the next 20 to 30 years, and I wanted more weight there than VOO alone gives me. The 5-year annualized return on QQQM is around 18% per year. The expense ratio is 0.15%. The trade-off is more volatility. This fund swings harder in both directions than VOO. But at 26, with decades ahead of me, I'm not losing sleep over short-term dips. The third position is VXUS. That's Vanguard's Total International Stock ETF, and it's 15% of my portfolio. This is the one I think most young investors ignore, and I think that's a mistake. VXUS gives me exposure to over 8,000 companies outside the United States, Europe, Japan, emerging markets across Asia and Latin America, all of it in one fund with a 0.05% expense ratio. The honest reason I added it is this. I was almost entirely invested in U.S. stocks, and I started thinking about what happens if the U.S. market has a bad decade. It's happened before. There are 10-year periods where international markets significantly outperform the U.S. I don't know when that will happen again, and neither does anyone else. VXUS is my way of not having to know. So far in 2026, it's actually up over 15% year-to-date, ahead of VOO for this period. I don't know if that continues. I just keep adding to it monthly. The fourth position is SCHD. That's Schwab's U.S. Dividend Equity ETF, and it's 10% of my portfolio. SCHD holds around 100 high-quality U.S. companies that consistently pay dividends, stable, established businesses across healthcare, consumer staples, and energy. The dividend yield right now is around 3.4%, and the expense ratio is 0.06%. Every quarter, this fund pays me a dividend just for holding shares. I want to be transparent about why it's only 10%. At 26, passive income isn't my top priority right now. Compounding growth matters more at this stage, but I like having it as a foundation. and I'll grow this position significantly in my 30s and 40s as my priorities shift. The fifth position is a sector ETF that makes up about 5% of my portfolio, and I'm going to be honest with you about it because I think the lesson is more valuable than the position. I bought it because I saw everyone talking about it online, and I didn't want to miss out. I'm down on it. I chased hype instead of conviction, and I'm sitting with the consequences. I'm including it because this channel is about financial transparency, and the lesson is simple. If you're going to own anything beyond a core index fund, make sure you genuinely believe in it for the next 10 to 20 years. Not because it's trending this week. And the remaining 5% is in a handful of individual stocks. I'm not going into those today because this video is specifically about the ETF foundation. But I want to be clear that stock picking is the smallest, lowest priority part of my portfolio, not the core. The core is what I just showed you. So let me give you the full picture. VOO at 45%, QQQM at 20%, VXUS at 15%, SCHD at 10%, sector ETF at 5%, individual stocks at 5%. That's 100%. And yes, VOO and QQQM overlap significantly. It's not a perfectly optimized allocation, but I have automated contributions running every single month across these positions, and that automation, to money moving in consistently regardless of what the market is doing, is more responsible for where I am than any individual ETF I picked. The habit beats the strategy every time. Now, let's talk about how you actually start this from wherever you are right now. If you have $100, the goal is not to build the perfect portfolio. The goal is to become the kind of person who invests. Open an account, put $100 into VOO or any broad index ETF, and watch it for a month. The habit is everything at this stage. That $100 is not going to change your financial life. Becoming someone who consistently puts money to work absolutely will. If you have $1,000, keep it simple. Put the whole thing into VOO, one fund. You're instantly diversified across 500 of the most powerful companies in the world for $3 a year in fees. You can always add complexity later. Starting simply and actually doing it beats waiting for the perfect strategy every single time. If you have $10,000, the most important decision isn't which ETFs to buy. It's where you hold them. In 2026, you can contribute up to $7,500 per year to a Roth IRA. Every dollar of gains you make inside a Roth IRA is completely tax-free. You invest money you've already paid taxes on. It compounds for decades. And when you retire, the government gets nothing. If I were starting over with $10,000 today, I'd put $7,500 into a Roth IRA invested in VOO and QQQM, and the remaining $2,500 into a regular brokerage account with the same allocation. Same investments, different account. And that difference will likely be worth tens of thousands of dollars by the time you retire. And then automate it. Whatever amount you can commit to each month, set it up so it moves automatically. You don't have to decide whether the market feels right. It just happens. That system is the biggest reason my portfolio looks the way it does. At 18, I thought investing was about finding the next big winner. At 26, after building over $400,000 invested, I think it's mostly about consistency. The biggest difference between people who build wealth and people who don't isn't intelligence. It isn't timing. It isn't finding the right stock. It's staying invested long enough for compounding to do its job. If you can build that habit, if you can resist the urge to chase the next hot thing and just stay boring, I genuinely believe you'll be in a better position than most people who spend years trying to be clever about money. That's it. I'll see you in the next one.